Let me ask you a simple question. How can silver crash nearly $25 in a matter of days, while at the exact same time, nobody can actually buy it? How can the price fall from $121 to $95 while mints shut down, dealers default, and shelves go empty? Because that's exactly what just happened. Once you understand why, you'll realize this wasn't a crash at all. It was a magic trick. In late January 2026, silver experienced what the mainstream media immediately called a violent correction. Headlines screamed panic. Charts went vertical, straight down. Commentators told you the bubble had burst, that silver had finally come back to reality. But reality was somewhere else entirely. Because while the paper price collapsed, something very strange was happening in the real world. The Perth Mint halted sales. The US Mint quietly suspended availability. The Royal Mint showed delays and shortages. In India, the world's largest retail silver market, dealers defaulted on delivery contracts. In Costco had to limit how much silver customers could buy. Let that sink in. If silver was crashing, why was nobody willing or able to sell it? This is where most people get confused, because they assume there is one silver market. There isn't. There are two, and they are no longer connected. The first is the one you see on your screen, the futures price, the ETF price, the ticker symbol. This is the paper silver market, a market where contracts are traded digitally, often backed by nothing more than a promise. No bars, no coins, just leverage. The second market is the one that actually matters. The physical silver market, bars, rounds, coins, industrial supply, delivery. And this market is not crashing, it is breaking. The crash you saw happened almost entirely during US trading hours. Not Asia, not Europe, America. Large, aggressive sell orders dumped into thin liquidity. Not because someone wanted out, but because someone wanted the price lower. Why? Because price controls only work in paper markets. And silver has been in a 5-year supply deficit. 5 years. Over 800 million ounces more consumed than produced. That deficit didn't disappear because a chart went down. It just got ignored. Let's talk about China, because China isn't trading charts. China is draining vaults. On the Shanghai Futures Exchange, 27 tons of silver were removed in a single day. One day. And total Chinese exchange inventories now represent barely 1% of annual global demand. That's not a buffer, that's a countdown. China has also restricted silver exports. Quietly, strategically, treating silver the same way nations treat oil, gas, semiconductors, as a strategic asset. Because silver isn't just money, it's infrastructure. Solar, electronics, defense, AI. And once it's consumed, it's gone. Now look at lease rates, because lease rates don't lie. They can't. The cost to borrow physical silver exploded 10%, 20%. At points, nearly 40% annualized. That doesn't happen in a glut. That happens when there is nothing left to borrow, when refiners, mints, and manufacturers are desperate for metal. And yet, the paper price collapsed. How? Because the paper market doesn't need metal to function. It only needs confidence, and confidence can be shaken. This is the oldest trick in the book. Crash the price. Scare retail investors. Flush weak hands. Shake out physical holders. So the metal flows from fear to strength, from public hands to institutional vaults. This happened before. In 1979, in 1980, paper prices were attacked. Margins were raised. Selling was forced. And then, when physical supply was gone, the price exploded. Violently, uncontrollably. What you just witnessed was not the end of silver's move. It was the system trying to regain control. And here's the most important part. If you hold paper silver, an ETF, a derivative, a futures contract. What you own is a promise, not metal. And promises are only good if delivery is possible. Physical silver doesn't care about paper crashes. You can't print it. You can't rehypothecate it. You can't sell it 10 times over. When it's gone, it's gone. This crash was designed to make you doubt reality, to make you question what you can see with your own eyes. Empty shelves, closed mints, no bid markets, defaulted deliveries. In part 2, we're going to talk about how this ends, why the gap between paper and physical cannot close gently, why one of these markets must break, and what happens when confidence finally snaps. Because this wasn't the collapse of silver, it was the exposure of the system. Here's the part nobody on financial television wants to say out loud. The gap between paper silver and physical silver cannot exist forever. One of them has to give. And history tells us exactly which one it will be. Paper markets survive on confidence. Physical markets survive on reality. And reality is winning. Right now, the silver market is stretched tighter than at any point in modern history. 5 consecutive years of supply deficits. Above-ground inventories drained. Industrial demand accelerating. Strategic stockpiling by nation-states. And a derivatives market built on the assumption that nobody ever asks for delivery. That assumption is breaking. Because when physical shortages become visible, behavior changes. People stop trading silver and start hoarding it. This is why dealers are going no bid. This is why mints can't price a product. This is why wholesalers are refusing orders. They're not dumb. They know that selling metal today means trying to replace it tomorrow at a price that might not exist. And this is where the paper market loses control. Because the paper price only works if physical flows freely. Once that flow stops, the paper price becomes a suggestion. We've already seen this movie. In 1979, silver inventories were tight. The paper market said one thing, the physical market said another. And when the dam finally broke, silver didn't rise gradually, it exploded. Back then, the system responded with emergency rules, margin hikes, trading halts, forced liquidations. Sound familiar? Today, the leverage is bigger, the deficits are worse, and the industrial dependency is far greater. Silver isn't just a monetary metal anymore, it's a technological choke point. Solar panels don't work without it. EVs don't function without it. Data centers depend on it. Military hardware requires it. You can't substitute silver at scale. Physics doesn't negotiate. And this is why China is acting now, not later. Not after prices explode. Now. Draining vaults. Restricting exports. Letting Western paper markets do the dirty work of suppressing price while they take delivery, that's not manipulation. That's strategy. Meanwhile, Western investors are being trained to trust charts. To believe the screen, to panic when numbers go red, and to sell physical assets because a derivative moved. But here's the truth. The paper market didn't discover price. It lost control of it. When physical silver becomes unobtainable at the paper price, three things can happen. First, the paper price is forced upward violently to ration demand. This is the squeeze scenario, where silver gaps higher day after day and nobody can get in. Second, the market's split permanently. Paper silver becomes a casino. Physical silver trades privately, regionally at premiums the screen never shows. Third, and this is the most dangerous, delivery fails, force majeure, cash settlement, promises paid out in depreciating currency, metal gone, credibility destroyed. None of those outcomes are bearish for physical silver holders. Every one of them is catastrophic for paper holders. That's why this crash was necessary. It wasn't to end the bull market, it was to reset positioning, to scare, to delay, to buy time. But time is running out. Because silver is not optional, and shortages don't care about narratives. If you're holding physical silver, this wasn't your signal to sell, it was confirmation. If you're holding paper silver, you need to ask a hard question. What happens if everyone asks for the same thing at once? This isn't about getting rich quick. It's about understanding what's real and what's a promise. The crash was the illusion. The shortage is the truth. And history shows us how this ends. Not quietly, not gently, but all at once. If you want to stay ahead of what's coming, not react to it, subscribe. Because this story isn't over. It's just entering its final chapter.